In a $100 million leveraged buyout, the ambitious operator usually takes 100% of the operational risk for a 10% common equity pool. That 10% pool gets wiped out to exactly $0 at exit, while the financial sponsor converts the target company's debt into a 30% IRR. Welcome to the real game. Most executives believe holding a 10% equity stake in a private equity-backed buy-in makes them true co-owners who will share proportionally in the exit proceeds. It does not. You are suffering from the builder trap. You sit in a dark room shipping world-class systems alone and fast. You perfect products instead of selling them. You avoid the hard human conversations that actually pay, and when the men in suits hand you a term sheet, you look at the 10% headline number, smile, and go back to work. You'd rather learn a new programming language over a weekend than read a 40-page operating agreement. The sponsor knows this. They are counting on it. Today, you will master the structural mechanics of the capital waterfall, specifically how liquidation preferences, debt service priority, and cumulative preferred hurdles dilute operators to nothing. And you will learn to engineer pari-passu equity ratchets that guarantee 8-figure payouts when you actually deliver the results. Step 1. Understand that the company's own balance sheet pays for the buyout, not the sponsor's equity. Let's examine a standard $100 million LBO, a leveraged buyout, which is when a private equity firm buys a company using mostly borrowed money. The sponsor does not wire $100 million of their own cash. They fund 70% to 80% of the purchase price via debt. Usually $50 million in senior secured notes, bank loans backed directly by the company's hard assets, and $25 million in subordinated debt, riskier, higher interest loans sitting below the bank debt in priority. This debt requires collateral, the asset the lender can seize if you do not repay, like a house you rent out or a factory you own. But the sponsor doesn't pledge their own assets, they pledge yours. Your company's operational cash flows and assets are the collateral. They only put up $25 million in sponsor equity. Look at RJR Capital in 1982. William Simon and Ray Chambers orchestrated the LBO of Gibson Greetings. They bought the company for $80 million. They used exactly $1 million off their own equity capital. The other $79 million was debt, secured entirely against Gibson's real estate and inventory. 18 months later, they sold it in an IPO for $220 million. The company literally paid for its own capture. Which brings us to step 2, the equity waterfall trap. This structural mechanism guarantees the sponsor takes all profits first, leaving you holding a worthless bag. You think your 10% common equity sits side by side with their cash. It doesn't. Sponsors issue themselves 8% cumulative preferred equity. Cumulative preferred equity means shares that mandate a fixed annual dividend, usually 8%, that piles up every single year before anyone else gets a dime. And they attach a 2x liquidation preference to it. A liquidation preference is a rule that says the sponsor gets their original money back, times a multiplier, before your common shares see a single cent. Watch how the math murders you. Their $25 million equity injection grows at 8% compounding for 5 years. It becomes a $40 million preference hurdle. You slave for 5 years. You increase the enterprise value from $100 million to $110 million, a solid exit. The buyer wires $110 million. First, the remaining $60 million off debt is paid off. The bank always eats first. That leaves $50 million in net proceeds. Next in line is the sponsor's $40 million preference hurdle, plus their management catch-up fees. They take all $50 million. What is left for your 10% common equity pool? $0.0. Look at Clayton, Dublier, and Rice in 2005. They led the $15 billion buyout of Hertz from Ford. Before they even took it public, CDR and their partners extracted a $1 billion special dividend. A dividend recapitalization, borrowing money against the company to pay the owners cash immediately. They shifted all the capital downside to the common unit holders and the operational staff. You do the work, they take the cash. Step 3, the defense, how you structure the upside. To protect your upside, you never accept simple common equity. You demand pari-passu preferred units. Pari-passu Latin for on equal footing, so your shares pay out at the exact same time and priority as the sponsor's preference hurdles. And you negotiate catch-up performance ratchets. A ratchet is a mechanism that aggressively increases your ownership percentage once the investors hit their target return. You tie these ratchets directly to MOIC triggers. MOIC multiple on invested capital, the raw number of times the sponsor multiplied their cash. You negotiate a term where your 10% common pool jumps to 22.5% of total equity value once the sponsor hits a 2.5x MOIC. Or when they hit a 20% IRR, internal rate of return, the annualized growth rate of their investment. Look at Silver Lake's acquisition of Skype in 2009. Egon Durbin led the $2,750,000,000 buyout from eBay. But key management refused to roll over for standard common shares. They negotiated performance-based equity ratchets tied to EBITDA triggers. EBITDA earnings before interest, taxes, depreciation, and amortization, the raw, unmanipulated cash the business generates. When Microsoft bought Skype for $8,500,000,000 in 2011, Silver Lake made a fortune. But because of those structural ratchets, over $300 million was allocated directly to executive equity. They didn't just build the product, they built their position in the cap table. This brings us to you and the character required to survive this game. You must cultivate ruthless financial literacy over title vanity. Never accept the executive title of CEO without inspecting the liquidation waterfall. Because title without structural equity positioning is just high-stakes employee labor. You avoid these conversations because you fear conflict. You think if you just write better code, build a better system, the money will naturally flow to you. It won't. The cap table is a machine designed to route cash away from you and toward the capital. Unless you rewire it. So here is your assignment. You will audit your current operating agreement or incoming term sheet today. Calculate your net cash payout under 3 exit scenarios: 1, 2xev, 2, 0xev, and 3, 0xev. Factor in the debt paydown, factor in the cumulative preferred hurdles, factor in the sponsor's management fees. If your net share at a 1.5x EV exit is 0, you are being robbed. You will send a revised term sheet demanding a pari-passu catch-up ratchet before 5:00 p.m. tomorrow. I know your excuse. I don't have enough leverage against an institutional sponsor to negotiate the liquidation waterfall. Yes, you do. You are the operator. You are the one who actually ships the product and closes the clients. Without you, their spreadsheet is just a hallucination with a 2% management fee. Capital never yields to operational effort. It yields only to structural leverage. Subscribe to Wealth Code. We are rewiring your cap table.